Hey, so this PowerPoint recording is just to summarize macroeconomic policy decisions used to help the economy. In the first situation, we have high inflation, and so the goal is to slow the economy down to control that inflation. Remember, it's got to be demand pull, meaning consumers and businesses are just spending at a really high rate and they're pushing prices up. So GDP is strong and unemployment is very low. Our appropriate fiscal policy is called contractionary. And so the president and Congress would either decrease government spending or they could increase taxes or a combo. So that would slow things down so there'd be less spending. The other decision through monetary policy is also called contractionary policy. It's also known as tight money, and that's our decisions made by the Federal Reserve, also known as the central bank or the banker's bank. And the central bank or the Fed would increase the required reserve ratio, meaning banks wouldn't have as many excess reserves to make loans. They would increase the discount rate, really used as a communication tool by the Federal Reserve to tell banks, hey, slow down, stop making so many loans. And then the third policy, which is the most common, would be to sell bonds. And that's our open market operation. And it's used to increase the interest rate, because remember, when we sell bonds, the Federal Reserve is soaking up money. You have less money. So you as a consumer or you as a business would be buying the bond, they're selling the bond to you, and you have less money to spend. So that slows down inflation. Those three decisions made by the Federal Reserve increase the interest rate. Money is more rare, and so that slows down high inflation. Okay, and then our last situation is high unemployment. We're in a recession. The goal is to increase gross domestic product or real output, and therefore helping lower unemployment. Remember, it's cyclical unemployment because of the recession. A GDP gap is occurring, meaning we're not producing at our potential GDP. Our appropriate fiscal policy is expansionary, expand the economy, and we do that through increasing government spending, which we are doing right now. Or we decrease taxes so consumers have more leftover and businesses have more leftover income to spend, or a combo of the two. And then the other one, monetary policy, is also expansionary monetary policy. It's also known as easy money. It's decisions made by the Federal Reserve, also known as the central bank. And we lower the required reserve ratio, meaning banks don't have to keep as much in their vault. They can loan more money to consumers and businesses. We lower the discount rate used as a communication tool. That's what it costs to borrow money for a bank to borrow money from the Federal Reserve. And then the third decision would be to buy bonds. So when the Federal Reserve buys bonds, they're buying it from consumers like us. They're buying bonds from businesses. They're buying bonds from banks. So when they buy our bonds, they're giving us cash for it. And so when they give us cash, it lowers the interest rate and stimulates consumer and business spending, shifting aggregate demand back to the right, which lowers unemployment. Hopefully that helped. So I think that's kind of it. Have a great day, Lobos. Bye.